unfolds. Let's welcome Marc Franklin, the Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, joining in. Marc, thank you so much for joining in. Global cues are supportive, though global news are still multi-dimensionary. We get Donald Trump writing to the Fed chair. At the same time, there is no certainty when it comes to trade negotiations. While deal making continues, the stock markets are making a move of their own. So what do you look at, the stock market move or the news?
We have to look at the broader liquidity backdrop, which is generally quite conducive. The Treasury Secretary's policy pivot seems to be the case that they're not going to look to term out the debt, which means there's less pressure compared to previous expectations on long-end bond yields, which then puts less pressure on the cost of capital for equity markets. So all other things being equal, fundamentally, whilst there are some signs of moderating growth in the US economy, the general sentiment backdrop is somewhat constructive, notwithstanding the ongoing and persistent headline risk and uncertainties.
Marc, hi, morning. Let's talk about the Fed rate cuts. When do you expect the first, Fed rate cut? How many this year? And sometimes it's not about when it starts, but where it eventually ends, right? So how many rate cuts do you expect in this particular cycle? Because it's possible that we're not going to go back to those near zero levels that we enjoyed a couple of years back. So what would be the end point of the rate cuts?
There seems to be now about 2.5 rate cuts priced in by the market by the end of this year, and a further 2.5 rate cuts priced for next year. So that takes the terminal rate down to high twos, around 3%. That's not an unreasonable expectation if you believe that core PCE can stabilise around the 2 to 2.5%, because then you have a real yield of about 1%, and that's somewhat of a neutral policy setting. But there's so many things in flux at the moment, and indeed that market pricing has moved ahead of the dot plot by the Fed officials. So clearly, the market is forming its own opinion in terms of data progression, both on the price and on the growth side. But it's not an unreasonable starting point if the assumption is that tariffs, by and large, won't be quite as inflationary or persistently inflationary as some of the fears being echoed by Chair Powell and other committee members.
All right. Hi, Marc. Good to see you, Ben. What about equities? How do you approach it? I think earlier this year you were leaning more towards, developed markets, and you said that there could be some kind of move out from the emerging markets. How are you positioned right now? Because both segments of the market are doing well. Some of the emerging markets like India and the US markets as well have seen a big rebound. So what's your take?
There's been a sort of a year of two halves so far this year, up until the early April correction and trough. Rest of world was very much leading US equities. And then since the bottoming out and the rebound, US equities have kind of come back to the fore. And what this is probably telling you is that the market is starting to settle back on those large growth-oriented business models in a moderating growth, moderating inflation dynamic. So a somewhat of a Goldilocks expectation around near-term macroeconomic developments does suggest that barbell approach of having large cap growth, even with the valuations that they offer, alongside the more discounted, higher return potential markets as well. Now, if either the growth data or the inflation data inflects and breaks in an opposite direction, the market will have to recalibrate where it sees the best chance of making returns this year. So let's take two scenarios in turn. The first scenario would be if inflation does start to re-accelerate to the upside, you could see a shift back towards more value-oriented, more discounted cyclical parts of the market, and those business models that give you some kind of inflation protection. And equally, if growth actually accelerates to the downside, you might see a pivot back towards more defensive quality factors.
Right. What kind of probability do you assign to, inflation moving on the upside? Because not only do we have the tariff negotiations, which are currently underway, the street believes that may be inflationary. You aren't in that camp. The second part is that there is this big spending bill that will come by as well. So the government spending a lot more, then that could also have inflationary impact, right?
So let's take those two things in turn. With respect to tariffs, no one really knows where tariffs will end up, both in terms of the size of the tariffs and their breadth of coverage. Even if there is a universal 10% tariff that most trading partners with the US accept, they'll equally be pushing for exemptions for certain sectors as well. But equally, some countries will be forced to shift back to the initial tariff rates that the Trump administration proposed in early April if they can't make progress on trade deals. So many uncertainties out there. Our view would be, even if there is a broad-based significant increase in tariffs, that will likely cause a material price impact in the short term and for the first few months. But it's not clear that that price spike will be sustained and will be persistent beyond the first 12 months or so. And then with respect to the fiscal bill that's currently being read in the Senate, the bigger question is, let's say, for example, significant tax cuts for both corporates and certain parts of the population prevail. How will they deploy those tax cuts? If you go back to the first Trump administration and the significant corporate tax cuts, our analysis tells us that a majority of the proceeds from that went into buying back stock. They didn't go into, for example, boosting investment or increasing wages to workers. And so the transmission impact on the real economy was somewhat limited. So that's an example where the devil is really in the detail, the extent to which there is a spending impact, both from the corporate and the household level, from any fiscal tailwinds.
Marc, in terms of global equities now, which are the markets that you like, you're overweight? What would your call be on India, for instance, and even some sectoral themes that you like? Provide some flavor on that.
Yeah, so the way that we're approaching our equities portfolio construction is to have certain expressions which give us a good risk reward. So we're looking for markets that have attractive valuations, high total return potential. I stress total return, both dividends and decent earnings growth as well. So actually markets such as the UK, for example, and to some extent Australia, give you reasonable total return because of the dividend profile and the starting valuations. Then we're looking for secular themes that we think can deliver compound earnings growth for multiple years to come as a result of shifts in geopolitics and geoeconomics. So some of the themes that we like, for example, are defense technology, cybersecurity, industrial renaissance, the reshoring of supply chains back to the US. And then with respect to India, one of the things that is a potential catalyst is with inflation being very well behaved, we've now seen the RBI start a cutting cycle, and they moved quite aggressively with their first cut. That gives the Indian economy a chance to try to reflate the cycle, particularly via bank lending growth, which, as we've seen, has been coming down slightly as well. So that creates an interesting narrative of reacceleration, but we really need to watch to see whether demand for credit indeed picks up. And with respect to sort of valuations in India, whilst positioning by foreign investors is not as stretched as it was a few months ago, there wasn't really much of a valuation reset over that period of time. And so the starting potential in terms of re-rating of the multiple is somewhat limited, and therefore it's going to be about the earnings growth story.
So are you overweight India?
It depends on the portfolio, really. I would say that we're broadly fully allocated, neutral against benchmarks. We want to see evidence that the credit loan cycle will pick up as a result of rate cuts. And then as well, there's an opportunity cost angle as well within an Asia context. If you look at markets such as Korea over the last 2 weeks, Hong Kong, China at the start of the year, when you have discounted markets in an Asia region with a positive catalyst, that can really attract investor attention and capital allocation. And sometimes the Indian market serves as a bit of a funding source. So it's as much about whether there are other attractive opportunities within the region sitting alongside India, whether India stands out on its own in terms of an attractive investment case.
Well, Marc, sometimes it's macros before markets, and it seems the Indian macros at least are doing pretty okay, though the point on valuations is something that could be keeping money away for the time being. But the hope is that we see some foreign inflow flourish at some point of time. So we'll keep an eye out on that aspect. What about other asset classes? Gold, that seems to be going through a melt-up. It's holding around this, $3,200 to around $3,500 an ounce. Any view on that particular asset? Because it's been glittering, it's moved better than a lot of equity shares in the last 18 months or so.
Yeah, it's had a very strong run over the medium term. A couple of reasons for that. One is that you've had very strong central bank buying, not just by the PBOC in China, but other central banks as well, as a means to diversify their US dollar reserves, obviously gold being US dollar denominated, and also as a hedge from an inflation volatility and a geopolitical volatility perspective as well. None of those drivers go away. They just might go through a bit of a pause and often for good reasons. If inflation is tamed, if geopolitics goes through a period of quiet, which we would all appreciate, then gold may see a bit of profit taking given the strong run as you highlight. But some of those longer term drivers are likely to remain intact. And going back to the point about the US fiscal agenda, if that BBB bill gets passed and it's expansionary from a fiscal deficit perspective, that will create further discounting of the idea that inflation will remain volatile and perhaps at a higher plateau than it prevailed over the previous decade. And gold will benefit from that as effectively as a store of wealth, as a protection against that inflationary pulse. So our longer term secular view on gold remains positive, but we do think there are reasons why it could see a bit of a pause, some profit taking in the very short term.
So fundamentally, what would be the floor for gold according to you?
We have a fair value model, but it's not a specific pricing point. It typically oscillates with a range. And at current spot prices, we're at the top end of that fair value range. So in that sense, it goes back to my point. You could see a bit of profit taking, but that sort of fair value analysis is really a function of inflation dynamics, real rates, US dollar versus other currencies, and the policy mix as well. And many of those factors are in flux, as we've already talked about.
Right, Marc. Thank you so much for joining in and giving us your perspective on a whole host of things, global news, global cues, global markets, gold as well. With that,